Day 7, Trading Strategy, Live Market Commentary. What happens when a simple breakout strategy is tested from midnight until the London evening close? In today's session, we begin with a starting balance of $1,000. Use a position size of 3 shares and follow a strict set of trading rules. There will be no random entries, no emotional decisions, and no chasing the market. Every order, stop loss, take profit target, and trade adjustment will be made according to the strategy. By the end of the session, one trade will reach the full take profit target, another will move against us, and the account will still finish the day in profit. Let's begin Day 7. Before the trading window opens, the chart is prepared and all the necessary levels are marked. The official trading session runs from 12 midnight or 000 until 7 p.m. or 19 London time. A vertical line is drawn at exactly 12 to clearly mark the beginning of the trading window. At the same time, a horizontal line is placed at the current market price. This becomes our first official reference point. This reference price is important because both pending orders will be positioned around it. We place one pending buy order 10 pips above the reference point. We then place one pending sell order 10 pips below the reference point. The purpose of this setup is to allow the market to choose the direction. Instead of predicting whether the price will move upward or downward, we wait for momentum to activate one of the pending orders. Both positions are prepared with the same risk management settings. Each order has a 20 pip stop loss and a 40 pip take profit target. That gives each trade a potential 2-to-1 reward to risk structure. To save time, we had already created 2 order templates, one for the long position and one for the short position. These orders could then be cloned and adjusted quickly whenever a new reference point was required. The original templates were prepared with 10 pip stop losses, but before placing the orders into the market, both stop losses were adjusted to the strategy's required 20 pip distance. Now, everything is ready. The buy order is waiting 10 pips above the market. The sell order is waiting 10 pips below the market. The strategy also contains one extremely important rule. As soon as one pending order activates, the opposite pending order must be canceled immediately. We do not want both sides of the market opening at the same time. At approximately 2 a.m., the market begins moving lower. Price reaches the sell entry level, and the short order is activated. The market has selected the bearish direction. The pending buy order is deleted immediately. There is now only one active position in the market, the short trade. The stop loss remains 20 pips above the entry, while the take profit target is positioned 40 pips below it. The trade begins moving in our favor. Price gradually pushes downward, and the short position starts building open profit. There is no need to interfere with the trade. The strategy has already defined the entry, the risk, and the profit target. Our job is simply to observe the market and follow the trade management rules. The downward movement continues through the early part of the morning. By around 4:50 a.m., however, the market begins to change direction. Buyers start entering, and price begins moving upward. Some of the open profit starts disappearing. This is the moment when many traders become uncomfortable. They may close the trade too early, move their stop loss without a valid reason, or make an emotional decision because they are afraid of losing the profit they previously saw. However, our trade has not yet reached the level required for the break-even adjustment. The strategy says that the stop loss should only be moved once the position reaches 20 pips of profit. Until that happens, the original trading plan remains active. So we stay patient. The market continues fluctuating, but the short position remains open. After 7 a.m., selling pressure begins returning to the market. Price turns downward again, and the trade starts moving back in our favor. This is exactly why patience is so important. The earlier upward movement looked threatening, but it did not invalidate the trading setup. The bearish move begins developing again. At approximately 10:30 a.m., the short position finally reaches 20 pips of open profit. This activates one of the most important rules in the entire strategy. The stop loss is moved from its original position to the entry price. The trade is now protected at break even. This means that if the market completely reverses and reaches the adjusted stop loss, the position should close around the original entry level. The initial trading risk has now been significantly reduced. This break-even rule is extremely important because the position has already demonstrated that it can move in our favor. Instead of allowing a profitable trade to turn into a full losing trade, we protect the position while still giving the market enough space to reach the 40 pip take profit target. After the stop loss is moved, the market begins reversing once again. Price moves upward and the open profit falls from 20 pips to approximately 10 pips. The full take profit target has not yet been reached, but the position is still protected. There is no panic. There is no reason to close the trade manually. The stop loss is at break even, and the 40 pip take profit target remains active. The market continues moving between bullish and bearish pressure. This trade requires patience. Several hours have already passed since the original entry, but the strategy remains unchanged. Eventually, sellers return with much stronger momentum. Price begins moving downward quickly. The short position moves back into profit. 10 pips, 20 pips, 30 pips. The market continues accelerating toward the target. At approximately 2:10 p.m., the price reaches the take profit level. The first trade closes with the full 40 pip profit. This is an excellent result, but the most impressive part is not simply the number of pips earned. The position experienced several changes in direction. It moved into profit, retraced, moved into profit again, and then retraced once more. The trade only reached its target because the rules were followed with patience and discipline. Trade number 1 is complete. 40 pips have been secured. According to the strategy, when a trade ends in profit, we wait 10 minutes before creating the next reference point. The first position closes at approximately 2:10 p.m. Therefore, the next setup begins at 2:20 p.m. At 2:20 p.m., the current market price becomes the new reference level. Once again, we place a pending buy order 10 pips above the reference point. We also place a pending sell order 10 pips below it. Both positions have a 20 pip stop loss and a 40 pip take profit target. The same rules apply. Whichever order activates first becomes the active trade, and the opposite pending order must be canceled. At approximately 2:40 a.m., the market moves upward and activates the long position. The pending short order is immediately deleted. Trade number 2 is now active. This time, however, the market does not continue strongly in the direction of the entry. After activating the long order, price begins moving downward. The position moves into a loss. Unlike the first trade, this position never reaches 20 pips of profit. Therefore, the stop loss cannot be moved to break even. The original risk management structure remains in place. As the session continues, the market struggles to move upward. The long position remains under pressure, but the loss stays within the planned risk limit. This is another important part of the strategy. Not every trade will win. A profitable strategy does not need to produce a winning result on every entry. What matters is that losses are controlled while successful trades are allowed to reach their larger profit targets. The trading window is scheduled to close at 7 p.m. London time. As the closing time approaches, the long trade is still open and remains below the entry level. At exactly 7 p.m. or 19erd, the trading session ends. The position is closed according to the session rules. Trade number 2 finishes with a loss of 17 pips. Now we can calculate the final result. The first trade produced 40 pips of profit. The second trade lost 17 pips. 40 minus 17 leaves a net profit of 23 pips. With a position size of 3 shares, the 23 pip gain produces a daily profit of $69. The account began the day with a balance of $1,000. After adding the $69 profit, the session ends with a balance of $1,069. That represents a 6.9% increase for day 7. Overall, this was a mixed trading session. There was one strong winning trade and one losing trade. However, the winning position was larger than the loss, allowing the strategy to finish the day with a positive result. The main lesson from this session is the importance of disciplined execution. The first trade remained open for many hours. During that time, the market changed direction several times. Closing the position too early would have reduced the final result. Failing to move the stop loss to break even after reaching 20 pips of profit could also have exposed the trade to unnecessary risk. The second trade reminds us that losing positions are unavoidable. The objective is not to eliminate every loss. The objective is to follow a process that keeps losses controlled and allows profitable trades to generate a larger reward. Day 7 is now complete. Starting balance $1,000. Net result 23 pips. Daily profit $69. Ending balance $1,069. One winning trade, one losing trade, and most importantly, a profitable session achieved through patience, structured risk management, and consistent execution. This content documents a trading strategy test and is provided for educational purposes only. Trading involves significant financial risk, and past performance does not guarantee future results. One time